Welcome to your daily market brief. You look at the headlines, and they are just screaming chaos. But then you look at the markets, and they seem to be telling a completely different story. Today, we're going to dig into an analysis that suggests there might be a hidden logic behind all of this, a deliberate plan playing out right in front of us. Let's jump in.
So here's the big question. When you look at all the geopolitical tension, the market swings, is it all just random noise? Is it just one chaotic event after another? Or what if it isn't? What if what we're actually watching is a series of very calculated moves in a much, much larger game? That's the puzzle we're going to try and piece together today.
First things first, let's just talk about that feeling I think a lot of us have right now. This deep sense of contradiction. The news is telling us one thing, but the markets often feel like they're reading from a completely different script.
And this is exactly what I'm talking about. On one side, you've got the headlines. Recession is imminent. A global crisis is looming. An energy bomb is about to go off. But then you look at the reality on the ground, and you see a surprisingly resilient U.S. economy, a sharp rebound in the S&P 500, and a U.S. dollar that's actually getting stronger. It doesn't quite add up, does it?
So what gives? How do we make sense of this? Well, the analysis we're digging into today offers a pretty fascinating theory. What if these contradictions aren't an accident? What if they're actually the intended result of a deliberate, coordinated global strategy?
The idea here is that what looks like pure chaos to us is, from another perspective, a carefully executed plan. The goal isn't just about reacting to things as they happen, but about actively creating the conditions to achieve some very big, very long-term goals.
So what are these big goals? Well, according to this theory, here they are. First, lock down the Americas, from the North Pole all the way to the Gulf of Mexico. Next, weaken Europe's ability to act on its own, making it more dependent on the U.S. for things like energy and defense. Then, you've got to discredit the old-school organizations like the UN and NATO that could get in the way. And finally, the really big one, contain the economic growth of your main rival, China.
And that's really the heart of it. According to this view, all these moves, all this maneuvering, it's all aimed at one primary target, China's massive New Silk Road initiative. We're talking about a multi-trillion-dollar plan to basically rewire global trade through infrastructure, connecting Asia, Europe, and Africa, and putting China right at the center of it all.
And here's a perfect case study of how this strategy might work in practice. So China invests a fortune in this huge railway to get Iranian oil to its doorstep in just 2 weeks. That's a massive win, right? It bypasses all the slow, vulnerable sea routes. But then, a conflict conveniently flares up in the region, and boom, the rail line gets bombed. Now, the real impact isn't just the physical damage, it's the message it sends. It proves that a key piece of the Silk Road is vulnerable.
Okay, so that's the grand strategy. But how does a geopolitical chess match halfway around the world actually end up hitting your portfolio? Well, it all comes down to a powerful combination of markets, the media, and, you guessed it, human psychology.
This quote really just gets right to the point, doesn't it? The theory is that those scary headlines we saw earlier are deliberately amplified. The goal isn't just to report the news, it's to create a specific narrative designed to make people feel one thing: panic, especially everyday retail investors.
And why would you want to create panic? It's simple. Panic creates opportunity. When regular investors get scared, they often sell everything, sometimes at a huge loss, just to make the uncertainty stop. And that fire sale? Well, that's the perfect moment for the big institutional players, the so-called smart money, to swoop in and buy up those exact same assets for cheap.
Let's just walk through how this played out recently. So picture this. The market is flying high. Confidence is up. The S&P 500 hits a peak right around $7,000. Everything's looking good.
And then the narrative shifts. The headlines get dark. Fear starts to spread like wildfire, and the market takes a dive, all the way down to 6,500. This is that moment of maximum pain, the point where a lot of people probably just threw in the towel and hit the sell button. But just look what happens next. It's incredible. Just 2 days later, not even 2 full trading sessions, the S&P is already back up to 6,800. The bounce back was so fast, so powerful, that anyone who panicked and sold got completely whipsawed. They sold at the bottom and missed that entire rebound. So all of this brings us to the final, and frankly, the most provocative part of this whole analysis. If that drop in recovery was a manufactured event, what does that tell us about what's coming next? Well, the argument is that this was all just a setup. And here is the absolute kicker of this entire theory. That sharp recovery we just saw, it wasn't the all-clear signal. In fact, it might be the exact opposite. According to this view, it's a trap, designed to make everyone feel safe and secure right before a much bigger move.
So how does this trap work? The key concept is something called capital rotation. Now, this isn't just about stocks going up or down. We're talking about a massive strategic shift of money out of the financial world, Wall Street, and into the real economy. The economy of steel, concrete, and tangible things.
So where is all this capital supposedly headed? Well, think about it. It's going into rebuilding defense arsenals for the US and its allies. It's going into beefed up security spending in Europe. It's earmarked for the massive job of reconstructing economies in the Middle East, and it's even looking at future infrastructure projects in places that are being brought into this new sphere of influence.
Okay, so let's break down the predicted sequence of events. Step 1, the bait. The market keeps rallying, making everyone feel safe again. Step 2, the entry. All those retail investors who panic sold now have a serious case of FOMO, fear of missing out, so they jump back in. Step 3, the shift. But while everyone's looking at the stock market, the big money is quietly moving out of those stocks and into those real economy sectors we just talked about. And finally, step 4, the trap is sprung. A much deeper, much more serious correction hits the market, catching all those recently returned investors completely by surprise.
Now, to be fair, a lot of analysts who were calling for a big drop have been wrong about the timing. But the argument here is that they weren't necessarily wrong about the event itself, just about when it would happen. The underlying logic for a major correction driven by this huge rotation of capital is still very much in play.
And all of this leaves us with one heck of a question to chew on. We've seen what looks like chaos, we've seen a dizzying recovery, and now we've looked at a theory that says it's all part of a plan. So, you have to ask yourself, have we already been through the worst of it? Or is the real market volatility actually still ahead of us?